As you guys can tell, we are now starting to film everything we do because I want to capture anything I might say that might sound intelligent at some point. So it can be used in my behalf at some point. But no, thanks for coming. And tonight, this is kind of free form, but it's the market outlook for 2013, which was actually set up by LPL's research department, which I think is pretty neat because some of the thinking that I've been doing about the market is exactly what they've been saying about the market, which I am really very comfortable with, because I believe in 2013 it's going to be very similar to 2012, only we've got the political discussion still out there. You know, we had the fiscal cliff, and this whole presentation kind of boils down to 3 lanes of a highway per se. If you look back, it's like page 3, I think, of this whole thing. Because they talk about the bear path, the bull path, and the base path. And the base path is basically what we've got going on. The bear path would have been had we run over the fiscal cliff. And they kind of give you some different assets that they think in order of preference, starting at the top, going down to the least preferred down at the bottom. The bull path, I don't think we are on either, because this would represent a long-term settlement with regard to fiscal policy, monetary policy, the debt ceiling, spending, the whole 9 yards there. So we're in the middle, which is the good old base path. And if you look at it, it's really kind of cool. We're only a month into the market, and these guys have been dead on already. There's actually a stock trader's almanac. Has anybody ever put any stock in that sort of thing? You know, what has happened in the past, like when the full moon is out and the tide's up, this is what's going to happen. Well, they do a stock trader's almanac the same kind of way. And if the first week in January is positive and the entire month of January is positive, over 65% of the time the market goes up for that year. So that was really very nice news to hear, because if you look at the first week of January this year, we were setting records. I mean, we were popping up a couple hundred points a pop. And for the overall month, we were actually up. So in terms of an actual percentage, I couldn't give you the exact figure. I know it's better than 4, and I think it's close to 5. But I couldn't quote the exact figure on it. So that's really nice in that what they're telling us is coming to fruition here. The thing that I take exception with now is we need to start being careful, because this first month, this is the market. All right, whenever you have something that does this, what do you expect next? You expect it to start heading, all right? And this is really, it concerns me, because I don't think there's any new news. Have you all heard any new news that would change your thinking from what we were hearing about 6 months ago, other than the fiscal cliff was resolved for a short time? I haven't. Earnings have been
elected. We know who the president is.
Yeah, so we eliminated a little bit of uncertainty with the president, but we didn't eliminate any uncertainty with regard to how much money are we going to spend. You know, what's Congress going to do now that we have new congressmen? Has anybody heard anything about fiscal cliff or spending or the debt ceiling or any of that in the last 30 days, roughly?
That's Mr. Hope.
I'm a hokey. Good.
We're going to do the hokey pokey here in a minute.
Hey, the governor of Virginia had a hokey town today.
So,
Darryl, how about what's going on in the Middle East right now? How about what's happening in the
those thoughts affect what we're talking about, but not in a direct fashion. I tell you what really truly affects us more than anything else is companies making money and the economy being healthy. And what we're having the economy start to come around a little bit, but companies have been making record profits for the last 15 months probably. And now they're just starting to be recognized because the next round of earnings reports are now coming out. And these stocks are really reacting volatilely. I mean, you'll see one go up 20 points on bad news. And you'll see one go down 20 points on really good news. And that just depends on the company, and that's the finicky nature of the market, and the analysts and the portfolio managers. If Yahoo comes out and says, hey, our sales went up 15%, that to me sounds like good news. But if the sales went up 15%, but their profits went down by 5%, an analyst is going to look at that and go, well, that's bad news, because ultimately it's hurting the company, unless they can figure out how to take those new sales and turn those profitable. You know, it's a great thing to sell a whole bunch of stuff, but if you sell a whole bunch of stuff and don't make any money at it, that's an awful thing. You're talking about the market returns, not necessarily the profits of the companies.
Right.
So that's, you know, what ends up happening is the market lags earnings.
They don't correlate.
Right, there's not a direct correlation. The only true correlation is that over long periods of time, earnings go up for companies, and you tend to see those stock prices start to move up. And there's not a short-term correlation to that. And that's what really makes it difficult, because you start seeing conflicting messages out there. And, you know, even us, you know, we'll get a report from an analyst that says this is the greatest thing since sliced bread, and then you'll get another analyst reporting, oh, well, you need to be careful, and you get another analyst saying you need to sell this thing and run away. And that gets a bit confusing, but if you start to know who these analysts are, you can find the ones that are always wrong, and you can find the ones that are always right. And if you can identify who they are and how that works, that's where we kind of make our living, you know, kind of deciphering that information. Because basically what we're doing is we're taking it in, we're trying to filter it, and then give it back to you guys in terms of this is exactly what we're thinking with regard to what you have, and hopefully this is going to help the portfolio. We're not always right, obviously. There's not a person in this room that hasn't had a negative statement from me. And it's not, you know, that I'm trying to not make money, because we're always out here trying to make money for you. It just doesn't always work, you know, in the short term. Long term, we're going to look like geniuses, because I think we've been doing the right things for many, many years. And it's starting to show. So anyway, that's kind of me stepping up on my soapbox a little bit. You're going to hear this statement from me a lot. I am guardedly optimistic with regard to the markets. And the reason I say that is I think ultimately our path is going to be in a positive direction. I think we're going to make money, but it's going to be a real bumpy ride, guys. I mean, this first month has been fantastic, and I have absolutely no idea why. Because I'm looking at it going, keeps going up, no new news. There's a new Congress that's out there. We haven't heard, you know, much about the spending.
Maybe it's a good time to sell.
Well, it's not necessarily a good time to sell, but it is a great time to be aware. You know, what we want to do is what we've actually been doing is actually setting stops higher, because we've had this run up, and that's one methodology that we use. I mean, volatile. These are names that I'm looking for in 2013 to kind of be our marching orders. We're going to see asset rotations. Try to protect our downside. And cash flows. And this really hasn't changed from what we were doing in June. You know, we're still trying to do the same stuff. We thought the market was going to be okay. The market churned like crazy. I mean, everybody knows that. Gosh, felt like we were on a roller coaster ride last year. Still going to be volatile. The asset rotations, this is where we start looking at, okay, do we get into bonds? Do we get out of bonds? Do we go to hard assets? Do we buy stocks? That is kind of the artwork. You know, there's not a real hard science to that. But I think what you're going to find at some point is there's going to be a huge rotation out of bonds. I don't know when it's going to happen, but U.S. government bonds are at all-time highs price-wise, and they're at all-time low yield-wise. When you start to get that sort of scenario, that means that there will be a sell-off in bonds. We just don't know when it's going to happen. The government is actually artificially keeping that up. They just came out yesterday and said they're going to continue to buy $85 billion a month of our own securities. So I can't quite figure that. I mean, it's kind of like me buying something and then I say, I'm going to push the value of that up because I'm going to keep buying more of it, even though nobody else is buying it.
And to borrow money.
Oh, yeah.
That's the issue. Paying for it with somebody else's money.
Right. We're paying for it with our great-grandchildren's money at this point. And, you know, that's where we're going to have to pay the piper. Did anybody hear what President Obama said about a week ago about the spending ceiling?
We don't have a spending.
Well, we don't have a spending problem, but we're talking about the ceiling. He wants an executive order to allow the president, without a vote of Congress, to raise the debt limit. Without a vote. So think about that.
Because he knows he's not going to get a vote on it.
Well, that's the thing. You know, if you really listen to the Tea Party congressman trying to hold the line on taxes and spending, at some point there's going to be a breaking point. I don't know when, I don't know where, but it's going to happen. When that happens, I don't know what the market's reaction is going to be to that. I don't think it's going to be as volatile as, say, government employees' reactions will be, or government contractors, or even the military. I mean, think about it, if we hit a spending limit and now we've got a problem in Iran and we've got to go address it. Who's going to write the check? We're going to be in trouble, exactly. So those are issues. They are big issues. It's not something we're going to solve. You know, this is something that's going to have to be solved over many, many years of negotiations. And frankly, I hope people have the will to do it, because it takes a lot of guts and a lot of character to do something like that. And I'm not sure we have that in D.C. And when we're trying to protect the downside, we're trying to look at some complementary assets. And when we are managing an entire portfolio, we're going to have asset class doing better than another at all times to try to keep the boat afloat. But we're also going to be monitoring it to make sure that if it goes down, we have a proper plan to get out. They're going to be huge. Protection's going to be huge. But ultimately, I do think we're going to make money in 2013. I think in spite of our Congress, in spite of the economy, I mean, because I don't think the economy has really recovered yet. I don't know if you guys are seeing it personally, but the things that I'm starting to see is I'm starting to see some more construction. You know, there are new homes popping up. The road is getting built out of 95, so we're starting to see more trucks out there, which is nice because you're starting to see that activity. I'm just not sure if it's adding to anything at this point. So that's good to see, but I'm not seeing the people that have been unemployed getting new jobs. Anybody know somebody's been unemployed for more than a year? Do you guys understand the difference between tax-free, tax-deferred tax in terms of what we're doing? Okay. So in 2013, I think tax-free is a great place to be now. Tax-deferred may become a better place to be at some point, depending on what the ultimate tax policy is. You know, because it could be that you defer your taxes and then ultimately have 75% tax rates at some point. So then you're kind of shooting yourself in the foot. I mean, if you go back and consult some of the old tax tables from the 40s and 50s, we had some unbelievable tax rates. And at this point in time, I don't think anybody would stand for that, because I mean, you're north of 70% at that point. That's something else we need to deal with farther down the road in terms of disincentivizing folks to do well, because that's essentially what we're trying to do. Is, as a country, we seem to be trying to pull down the the folks that are really super successful rather than trying to build up the people that have not been successful. You know, we're kind of giving them things at this point. And I think that was a fundamental issue with regard to the presidential election. And the people spoke and said, we want to give money to people who don't really want to do anything. And to me, that goes against everything I believe about America. And I'm not 100% sure that we're going to be able to recover that. So we need to, collectively as citizens, we need to address that. That really surprised me is all the money that's sitting on the sidelines. There's still $4 trillion sitting in cash, getting 0.03%. Well, how do you know? I mean, really, that's the fundamental issue. If we knew when everybody in this room was going to die, we could manage your money right to that point and you'd be good. But if you live one day longer, what happens? It still has not been addressed. Since 2008, when interest rates started really hitting rock bottom, I was thinking money would be moving from cash and actually moving back through the economy, which is what the Fed's goal is. The Fed's goal is to keep interest rates so low that you need to take your money out and move it through the economy. The ultimate goal of the Fed is to keep the economy moving, okay, which is all about cash flow. And in order to get money moving through the economy, you have to give people incentive to move it, or disincentive to keep it. So, you know, 4.25%, if you can equate that to a CD, what are they getting? 0.6 for a year?
Less than 0.6 right now.
0.5. If you go 5 years, you can get a whopping 1%.
There you go, tying up your money for 5 years, you know, for 1%. Does that make any sense? Anybody up here want to sign up for that? Collect the dividends, and then if you ever need to sell it, you can sell it. But that really works well. And these are strategies that in 2013 I think are going to become more important. And what you're finding right now is these companies that are paying dividends have gone up in price, which has kind of pushed us here in January. When the market has been pushed, it's been because of these bigger stocks that pay these nice dividends. And I think it's a hunt for cash flow. So I mean, does this kind of stuff make sense in terms of what we're doing, generating cash flow and trying to get protection as well as trying to be diversified? Because when we start talking about diversification, you know, that's a big word that says don't put all your eggs in one basket. Some of the ways that we're starting to manage risk is trying to take more senior positions in companies. Does anybody know, y'all know what I'm talking about when I'm saying that? Senior positions. The general structure of a company, and this is going to be real basic here, guys. So it's ABC Company, all right, and Brandon owns this company. So he just started it. And Brandon started this with 1 million shares. All right, that's what he has said that he's going to sell to the public of his common stock. So when he does that, we now have 1 million shares out in the economy, right? These are all common stock shares, meaning that if Brandon doesn't run this company right and he goes belly up, you're out. You lose all your money. All right, so common shareholders are at the bottom of the rung. All right, so if the company goes belly up, these are the first people that lose. All right, everybody following that so far? The next step up are preferred shareholders. And these may or may not be able to vote, but they also act a bit like a bond in terms of these guys, since they're preferred, they have demanded that Brandon's going to pay them a little bit as we go, kind of like a bond would. Okay, so it's a little more senior than a common shareholder, so these guys would definitely be out of the bankruptcy. These guys may or may not be out. You can have preferred stocks in a company. Not all companies have them, but that's a good way to generate some cash flow. That's a good way to generate some additional protection with regard to your positions as well. Next step up from this are the bond holders. So he's issued all the stock he can issue, but he still needs money to go fund a new marketing plan. So he'll issue bonds and pay a premium to the actual folks that are lending him the money. Okay, so this is where the bondholders are coming in. These guys are much more senior than either of these two because the shares of stock are always diminished in the eyes of regulators and receivers for bankruptcy types of issues, okay? Okay, so bondholders, in terms of the overall financial markets, are in a pretty good spot. The people that are above bondholders are basically the banks that are lending the money. All right, so Brandon has, he built the building when he initially started the business, and he got the money from Union First Market. And they hold the first lien. Okay, so when he runs this company to the ground, this bank is going to come in and say, well, we lent you money, so we're in a senior position. The only position that the banks are subservient to are actually the government, the local governments. Well, local and federal. Okay. All right, but when we start talking about these financial markets, this is where we start to recognize, okay, we're safer here than we are here, but we might generate more returns in terms of being a common shareholder because there are really no strings. The bondholders, we always know what they're going to get paid in terms of an interest rate. So if it starts at 5%, they're going to continue to pay 5%. The only thing that adjusts there are the prices. Everybody following that? I know I can get a little carried away with that sometimes. But in terms of protecting ourselves in the portfolios, we're not all in common stock at this point. And we're starting to sprinkle in more preferreds. We have quite a few shorter duration types of bonds in our portfolios, but we also are trying to sprinkle in some high yield. You guys have probably seen that in your portfolios. The high yield bonds they're kind of the precursor to the stocks moving, because you start to see safe money being in cash, and then it kind of moves into bonds when it starts feeling a little more of its oats, and then it'll start stepping into preferred stocks, and then it'll start stepping into common stocks, and that's where you start to see the train rolling. That's when a nice bull market has really started its run. The reason most individuals don't know much about preferred stocks, they don't have much exposure to them. Exactly. Yeah, so what we're trying to do is that's a great word, to try to insulate the risk, because if we can do that, it kind of gives us a cushion all the way around. So is everybody good with this in terms of safety, you know, being common shareholders being the low guy on the totem pole? Well, and they are typically monopolies, you know, and they are regulated monopolies. So utilities can be good places to get cash flow. So when we start talking about cash flow and dividends, that's a place to get it, and in fact, but now you're starting to see monopolies start to merge, or not monopolies, but utilities start to merge. And that's a whole different beast, because now we're starting to get conglomerates who are crossing state lines, and I'm not 100% sure how all that works, you know, long term. Because historically what you've seen is from state to state to state, there are different regulatory boards. So utilities can be a place to generate cash flow. I'm not sure that they're a great place for total return at this point, because I think we've seen a lot of the run up there as well. Does anybody understand what a sell stop order is? Yeah, I tell you, I really don't have much else to say about 2013 at this point, other than what I'm looking at right now. And what I'm looking at is global opportunities. I'm looking at tax-free investments, and I'm looking at cash flow. And if we can look at those three items and then keep in the back of my mind, we always want to protect these types of positions, that's what we're doing. And it's working so far. And if you read through this and like it, there's actually a 24-page version of this thing, which I would not subject you to, so we did the abridged version. But this is really good stuff. I mean, they talk about the asset rotation, they talk about the issues that were being faced at the time that they wrote this. And I apologize, I thought this was done in December. This was actually done November 26th of last year, just to show you how good LPL's research is. And you don't typically find a lot of really consistently good research in terms of economic commentary, but LPL has it. We're in a very good spot, and I think it's in a very good time in history. But be aware, the congressional discourse is going to start heating up, And it's going to happen soon, because we're now 30 days into their 60-day cycle and nobody said a word about the new spending restrictions and the debt limit. They just went ahead and passed it, said okay, and Mr. Obama said I'd like to do it all by myself, but fortunately that hasn't come to pass yet. But the gun control is the big issue right now. That has really not much to do with the market, other than if you own Ruger or Smith & Wesson or something along those lines, which those stocks have done great. Well, yeah, actually Europe is a good place to find growth at this point. And what you want, I mean, because I can't really narrow it down and say you need to be in Australia or you need to be, but what you want more than anything else is you want boots on the ground. You want people who are there living it. You don't want somebody sitting in New York City saying, oh, well, I'm getting these reports out of Singapore that are great, so I'm going to invest in Singapore. Because the information that we get, and think about just the information that we all assimilate. Okay, we read the newspaper, we'll watch TV, right? People tell you how good things are or how bad things are. Then you get in your car and you drive down the road and you see something different. Because I believe there are two lenses that we all look through. We look at information that we're getting from the outside, and we look at information that we get from the inside. First person information is always going to be superior. Always trust yourself. So, I mean, we are looking at actual direct investments in those countries.
So the index going to make sense there?
It can. I mean, it depends on what the index is. If the index is too broad,
Right.
that doesn't help you.
Don't know.
Because, well, it's like buying the S&P 500 right now. There are 150 stocks in the S&P 500 that are going to be dogs. The other 350, half of those are going to be okay, and half of those are going to just, rock the world.
1/3 is doing good.
Right. And so if you could pick the right 1/3, then you'd be great. And that's where we start to depend on money managers actually outperforming what the market's doing to a large extent, which the portfolio managers that we've been dealing with have actually done that. But the boots on the ground, I mean, that guy's going to sit down with the CFO, and he's going to sit, tour the factory. But if you're dependent on somebody to report that back to you, that's where I think, you can get in trouble. So that's where we're real selective with regard to that sort of thing. And when you start to talk about indexes, having the index is not a bad thing, because that can be a base, and we can build from a base and get a little more specific as we go. Did that answer your question all right? Okay. I don't want anybody to walk out of here without an answer to your question. Is Obamacare going to affect the stock market in any way?
I mean, we're dealing with insurance, right?
Absolutely. It will affect the stock market to the extent that it affects earnings of companies. It's going to affect stocks to the extent that it affects earnings for companies. Okay, so if Obamacare becomes a drag, suddenly you've got to set up a 100-person unit in your company because you've got to monitor and work through this Obamacare, and you've got to deal with all the regulations that you haven't had to deal with before. That's a drag on earnings. Okay, so that could really hamper some companies. With regard to it affecting, say, a life insurance aspect of an insurance company, it's a totally different beast. Insurance is divided into several different types of coverages. Okay, there's property coverage, which would be if this building burned down, they'd pay for it. There's liability coverage. All of these risks are segmented within insurance companies. Life insurance and health insurance, even though you can sell them with the same license because you can be a life and health agent, they are not accounted for the same for companies. So you'll typically find healthcare specialty providers more so than you will, say, a broad, like, let's just use Geico. Okay, Geico sells auto, homeowners, motorcycle, RV, but they don't sell health insurance. Bless you. So the Obamacare, if it starts to affect the earnings of these companies and starts to affect the operation of these companies, can be a drag. I don't think it's going to be beneficial to companies at all. And it's because of it's a new thing. It's like the Patriot Act. When the Patriot Act came in, did you guys see a change in how you dealt with businesses? Now you got to have to, in order to deal with me now, I got to have a copy of your driver's license. We never used to do that before. We used to open up an account, just somebody would call us from California and say, hey, I got this going on, boom, there we had. Everything worked out well. But it became a drag, so it's caused us to use more time. So if we're paying somebody $20 an hour, and now part of that $20 is dedicated to getting some more regulation done, that's a drag on your earnings. They are probably going to be. I can't answer that question because I just don't know. The question was, are pharmaceutical companies going to be involved in the pricing of Obamacare? And I'm sure it's going to factor in. I just don't know how. I would imagine they're probably, some of them are licking their chops because they think they're going to have access to more folks than they've had before, and other ones are scared to death because now their premium price for the drug they've been getting is now going to be cut in half. So it can work both ways with regard to that. So I think you're going to see some interesting stuff come out of this. The effect of unintended consequences is what it's called. But the goal is to try to get more people covered. And what's going to end up happening is a lot of people are going to say, well, I'm not going to provide you with coverage anymore. So now you're going to have more people uncovered. And it's an awful cycle. And I don't think that any government official, and I'm using that as a broad term, understands really how to price risk.
People.
Yeah, they're not business people.
Politicians, and they've never made payroll.
That's true.
They don't get it.
And if you've never signed the front of a check, it's hard to explain to somebody. And that never really hit home to me until I started signing the fronts of checks. And when you start doing that, that really brings it home that these people are dependent on you doing well. Obamacare is going to be a very interesting beast, and I can tell you that millions, well, probably billions of dollars at this point are already being spent. Because I was at the table where I don't know if he was the president or just the local guy from Blue Cross Blue Shield, but he runs Blue Cross Blue Shield and Anthem in Richmond. And they had already cleared out an entire floor and built the infrastructure because they knew they were going to be the new gatekeeper. And this is before the vote came down. They said we have to be prepared. And I was really shocked by that because what's going to happen is everybody's going to go into one central resource, and then you're going to get kind of spun back out. Well, I don't know if it's going to go to a health insurance company or if it's going to be to Joe down the street who now is the representative for the government. I don't know. Obamacare is a big issue overall. When we start to factor this in, the real true cost is not going to reveal itself for probably 10 or 15 years, but it's going to be gigantic. And in the meantime, everybody has to try to manage their way through it. So did that answer your question, though? I think there's going to be winners and losers. I think there's going to be more losers than winners. Anybody have any other questions? Well, enjoy your dessert. Is everybody eating it?
We're on dessert. You haven't even eaten your salad.
Well,
It was very good.
I was always taught.
Ginger's like, shut
Hungry. All right.
Well, we don't even have Ginger's cheesecakes here tonight. I don't know. A few of y'all were at the holiday party. We actually have it on film, somebody asking who made those cheesecakes because they were so good. So you got some competition tonight. I'm going to try and see how this turns out. In 2012 and then 2013, I mean, it's really been fantastic. And it's because of folks like you saying, hey, go see Darryl. He might be able to help you out. And it makes a world of difference to us because we're not having to go out and look for a whole bunch of new clients so we can actually manage your accounts. If you think about the people that do what we do for a living, they're typically out there chasing people. And we're fortunate. We don't have to chase them. We typically attract them. And that's what we're trying to do. So please, put the word out there, and as long as you like what we're doing. If you don't like what we're doing, don't say anything. But we just want to keep serving you and keep doing the best we can. So thanks.
Thank you.
Appreciate it.
Thank you.
Happy birthday, this is your special day. We're glad you came to Lone Star to help me celebrate. We hope you had a good time, we're really glad you're here. So howdy, happy birthday, this is your special year.
Thank you all very much. Thank you.
Happy birthday. Happy
Thank you.
birthday.
Thank you very much. Thank you.
Can we get a box for everything for you?
Anything else? right now?
Sure. That'd be great. Thank you. Yesterday was my birthday, in case anybody was wondering. Thank you. That's it. All over again. Well, that was unique. I've never had that at one of my presentations.